I need some traction. You need some traction.
Hey everyone, Lloyd Lobo here, co-founder at Traction Conf and Boast AI. Thanks everyone for joining for another edition of our Traction webinar series. You know, we're all here to make money, right? But like everyone wants to work on ideas that they're passionate about and want to change the way people do things. And the goal of building a company is to make money. But how do you bake an exit strategy into your startup, into your business from day one, whether it's an M&A or it's IPO season right now, so whether it's an IPO or maybe a secondary sale of your shares or whatnot, right? And how do you do that? Because if you don't set that thinking into your DNA from the start, you'll make a lot of expensive mistakes as you move along in your journey. So I'm super excited to have serial entrepreneur and Silicon Valley VC, SC Moatti, today to give us the playbook, the exit playbook. SC has been a past Traction speaker and super high rated. So I'm excited to have you back today with us. How are you doing today, SC? How have you been coping with the fires and Corona over the last several months?
Yes, it's great to be back. I'm super thrilled to be here. I love the quality of the folks at Traction and the participant. It's awesome. So COVID, fires, elections, you name it, like we're ready for it. I've decided that last week was Jewish New Year. I celebrated. There's going to be Diwali. There's going to be a few sort of, these, different New Years. I'm going to celebrate all of them because I can't wait for this series of crazy events to be done.
One quick question. I'm hearing rumblings that depending on the direction of the election, the market may go to crap. And so if entrepreneurs are raising, they should close their round right now. How do you feel about that?
Yes, it's it's a rumor I'm hearing as well. Definitely during times of uncertainty, if you've tried to raise money, in like March or April of this year, you probably saw that it was really challenging. The elections take place in November. So if you want to close around, make sure you close it before that. But that's not really different than every year. Closing around before Thanksgiving is generally a good idea if you want to close it, in the specific year, because things really slow down in December and then they slowly pick up in January. So it's either going to be like October, November, or February. But I don't think that's different than any other year.
You have a great set of slides and an awesome presentation on the ultimate playbook for exit. So I'll let you take it away.
When you think about an exit, if you have taken investor money, for your investors, the difference between you having an exit and not is the difference between success and failure. And so it's really important to have an exit strategy. It's also important for you, right? Like one of the key reasons, certainly I, as an entrepreneur, and I imagine you are entrepreneurs, is because we want more than being an employee, right? And an employee is doing just that, collecting a paycheck, versus an entrepreneur is building something that hopefully will have a legacy, will be longer lasting than just themselves, or will make a lot of money. Regardless of what your goal is, your exit strategy and having a playbook for exit is really, really critical. So a quick introduction about myself. I'm the founder and managing partner of Moatti Capital, which is a venture capital firm that invests in early growth. So typically that's Series A. And the reason we have amazing entrepreneurs like Spencer's at Amplitude, and we also have DigitalOcean, Airbnb on our cap table, is because we give them access to over 300,000 product managers. And product managers in large enterprises are very often buyers or key influencers of purchasing decisions. So they're basically a buyer's network. They help you sell your product faster and better. And how we got access to that audience is through our sister organization, Products That Count, which is one of the largest networks of product managers. It's a very engaged organization. We produce content every day. All the content is authored by C-level, VP level in product. So it's really an authority, if you want, when it comes to what makes a great product. Now, I'll start with this, right? When you're starting a company, you're at year zero. And typically, if you're on the right track, if you're participating in this webinar, things are probably on the up and up, maybe a little bumpy road with COVID, but we're gonna assume that things are looking good for you. So you're in that growth phase. And the last thing you want to hear at that time is that you're going to sell the company or you're going to exit. But that's actually a great time to think about an exit strategy, because when things go on the up and up like this, and you start to attract maybe some interest from potential buyers, that's exactly when you're going to maximize the value of your company. And if you press forward a little farther, what typically happens is you hit something that's called bump on the road. To which most founders, most entrepreneurs will say, oh, I just hit a bump on the road, but things are looking awesome and we're going to recover. And unfortunately, the reality, and I know it's not necessarily fun to hear that, but the reality is once you hit bump on the road, you sort of stabilize into a steady state that may not be as exciting as things were looking in that fast growth phase. And that's typically when founders are like, oh, well, I've had my fun, now I want to exit. But that's not a great time to exit. And so my first advice to you when you think about that exit playbook is sell early, or start thinking about selling early. Of course, you will always have exceptions. You will always have the situation where you're going to build a company that's going to become like the next Salesforce, or going to become the next Facebook. But that's like a one in a million company. For most of us, this is the trajectory of our company. And so exiting early is actually a smarter strategy, especially because most entrepreneurs have more than one idea in them. It's only when I listen to entrepreneurs be so passionate about their company, and they say, I don't want to sell it, I want to run it forever. I say, well, don't you have another business idea? And oh yeah, actually, in fact, I've been working on this thing on the side and so on. So don't worry, like your mojo is not going to go away if you sell your company. In fact, it's going to come back even stronger, and you'll have the confidence, the accomplishment of your first exit. So you'll be in a completely different ballgame. So especially if you're a first-time entrepreneur, like think about selling super early so you maximize your exit and your time. The second kind of key thing that I want to discuss here with you is, what is it that you're selling when you exit? And it's really important, because what most entrepreneurs are selling every day is their product. They go to a potential customer, prospect, and they say, you should really buy my product or my service because it has, this feature or that benefit and so on. But when you sell your company, generally you sell one of three things. You sell your team, you sell your book of business, your customers, or you sell your EBITDA or your profit. So we're going to look at each of them. If you are early in your growth, chances are you will sell mostly your team or technology, IP, and you will sell it to a company that is struggling to innovate, which means that, for example, if you think a few years ago, Yahoo was having a lot of trouble embracing a mobile transition. They made a bunch of acquisitions that helped them bring mobile talent because they couldn't develop it internally. You see that all the time. These exits tend to be relatively small, where people say, oh man, I need to really like have a solid like data science slash AI machine learning team. I'm going to make an acquisition of a team who is expert in data science, machine learning, and already knows how to work together. And that will strengthen my own rank. And then I'm going to put them to work on my own products because I have scale, I have a strategy, and so on. These types of exits, you end up working for the company for a while, especially if you're in the engineering team, and they typically are under 20 million. The next type of exit, you sell your customers, you sell your book of business. And so this will typically be an exit where you have maybe a company that's doing something similar to you, but in a different region or in a slightly different industry segment. And they're saying, we want to expand into the segment you play in or the region you play in. And so we're going to buy you out and we're going to buy your book of business and most likely sell them a combination of your and our product. And then in our own region or with our own segment of customers, we're going to try to upsell also your product. Why not? But you know, these products might be competitive to one another. Another reason to sell your book of business is you have a private equity firm who's looking to do a roll up. That will be something that will typically happen. And the ticket price on that type of exit, generally speaking, 20 to 50 million. And then finally, you could sell profit, you could sell EBITDA, and you would typically sell that to a company that has a share price that may be tumbling a little bit and they need to boost it. And so in order to do that, they're going to actually make some strategic acquisition so that they can bolster their profit or their EBITDA, and that hopefully impacts their stock price in the right direction. And typically these exits are between 50 and $100 million. And I'm talking here all US dollars. Now, if you're looking at this and you're reading the news, you're probably going to be asking me like, SC, that's great, but these are small potatoes, right? Like 50 million, 20 million. What about these massive, billion-dollar exit? What about these unicorns? Like, what about that? Like, that's what I want. Well, first of all, it's talked about in the news because it's rare. And so it's generally the exception, not the norm. And second, you have to ask yourself, who can afford to buy a company that costs more than $100 million, right? Who has a balance sheet that's healthy enough to write a check that's 200, 500 million dollars, $1 billion, $19 billion, what have you. Very, very few players. So almost nobody can afford to buy a company at that price, which is why these are extremely rare. But also, even looking at the statistics, right? 97% of exits are $100 million or less. And so unless you are convinced that you are in that 3%, which if you are, you will know it, then you're better off considering an option that's one of these three buckets. So that's sort of once you're far along enough that you're considering exits, right? Consider them early, consider what you're actually selling. But what I'm also going to spend some time doing today is giving you some keys to how you can maximize your exit value when you raise money. And I say that because I see a lot of entrepreneurs who come to us and they pitch us a company that is what we call in the industry a lifestyle company, a company that is unlikely to have a successful exit. And so I want to give you maybe a few kind of basics to fundraising with your exit strategy in mind. So the first thing is, there are a few misconceptions in fundraising, which are that, which are coming from the Facebook effect. I know Facebook's controversial these days, but still the majority of entrepreneurs we see want to be the next Mark Zuckerberg. And so when I peel that off, I spent a couple of years at Facebook. When I peel that off, I hear like, okay, so I'm going to be dropping out of college because I don't need a business degree to run a successful business or to exit it. And all I need to do is build a great product, and my customers will come. And by the way, I want full control over my exit strategy, over my business altogether. And so I don't want investors to have a say. Well, a couple of things on that. One, business owner don't need a degree. Completely false. If you compare apples to apples, people with a business degree who run a business, people without a business degree who run a business, you're actually 6 times more likely to run a business with a degree than without a degree. No matter how popular you see some of these college dropouts, that's like, again, that's like in the news because it's rare. So when I talk to students who are looking to build a company and exit it, I tell them like, okay, well, you're in the right place. You need to keep studying. The second myth, right? Build it and they will come. Absolutely not true. We see that now with all the controversy around, the advertising business model that's not doing so well. In fact, when you look at most of the companies that are unicorns today or that have been started after that social wave since 2008, the very, very large majority, they have a different business model. They have a SaaS business model. They have a membership business model. And I know that at Traction, most of the folks have SaaS business models. So I'm not going to expand too much on that. I'm assuming that you guys are great at the business basics. And then finally, the idea that investors have no say in your business strategy or in your exit strategy is also inaccurate. Your investors will be super helpful in helping you evaluate your different options. And then, when I just think about like, if you could have one of these 2 investors, I'm pretty sure one of them, and I'm pretty sure you'd be excited to have the money from that person, right? This is Warren Buffett, of course. And Warren Buffett, when he gets into a company, he does a lot of due diligence, he does a lot of evaluation. In fact, like this is his approach to due diligence. But once you get that money, you have smart money, and it opens up a lot of doors. Let me tell you a story, an exit story of a company who wasn't sophisticated enough at the time to focus on raising smart money. So they raised money from that other guy, that other picture, somebody who's not a sophisticated investor. And one day the founder, the CEO, comes to me and asks me, hey, SC, we're raising our next round and the company is doing great, and everything is like up and to the right. Oh, by the way, at the end of the pitch, by the way, I wanted to mention we've been in discussion with a couple of companies about an exit strategy. And I'm like, okay, well, that's awesome. Like, why don't you, what are you doing here? Why don't you go and pursue, that option or line up a few other options? Well, I'm not quite sure. So my next question is, okay, so who's on your board? Who's helping you navigate that exit? Well, that's the thing. My investors, they're on the board, but really anyways, long story short, they're not sophisticated. They don't know how to handle that situation. This entrepreneur is a first-time entrepreneur, so he doesn't know how to handle that situation. And so the potential that he's going to waste his exit opportunity is huge. And it's such a shame, right? You can imagine, like, if he sold and then started another company, his life would be completely different. But because he doesn't have smart money, he's struggling to navigate that unusual event. Anyway, so my message here is really enroll your investor when you're evaluating your exit strategy, because they see exit strategies, they see exit scenarios very often, and they can help you maximize your outcome. When's a good time to raise money? When you need it. I know it's a very simple answer, but you know, if you're early in your company, don't raise money when you have nothing that you can prove. Don't raise money just because you can, because you're going to raise on bad terms. We're actually going to be covering that. When you're a little farther along, you know, a lot of people think like, oh, I'm going to raise money when I sign up customers. Wait a little bit more, like implement, get feedback, see the impact it has, your product can have on your customers, because that will really de-risk the opportunity you can raise on much better terms. So raise money only when you need it, and raise money like in small increments early on. And then once you have a proven go-to-market, then you can be a lot more aggressive. That's how you want to do that. Another question about how you put yourself on the radar of an acquirer, and that's obviously $1 million question. Companies are bought and not sold, and so the key here is generally these conversations, they will start with a partnership discussion. Like, hey, a big company will come to you and say, interesting, or you through your sales process, you'll get to know them. And they'll be like, oh, you have such an interesting product, such a great technology, we love it. Maybe we could help you. Let's explore a deeper partnership. That's when you know that there's possibly an M&A interest. And what you want to do at this point is go to your business advisors, try to generate an LOI from them, letter of intent, that yes, like there's interest in possibly acquiring them. Once you have that interest, you really have to think hard. You have to decide whether you as an entrepreneur want to exit, you want to sell. And if the answer is no, then, okay, it's opportunistic. What's my number? What would be so convincing that I would stop running the business and sell? Don't go with something crazy, right? Don't go with like a completely outrageous multiple, because you might as well not play, right? Go with something that you think it's fair, and that would make you happy. And if you can get it, great. If not, keep running the business. But if you decide you're going to exit the business, then my recommendation to you is to hire an investment banker, because it's going to be their job to open up the pool of buyers for you and maximize your options. And so how you do that, like if you look at exits, it's really interesting. Like most of the entrepreneurs we talk to, they say, oh, I want to be sold to Salesforce or what have you, or to Google. But when you look at what Salesforce and Google buy, generally speaking, it's either a very tiny team for a few $1 million because they need like a very specific knowledge here and there in a niche, or a massive brand, right? So it's like a billion or tens of billions of dollars. In between, it's kind of rare, and it's not in their core business. So Google, for example, they made a few hardware acquisitions that were in that sort of mid-size range. But for you to think, like, say you have a CRM SaaS offering that you're going to sell to Salesforce, it's very unlikely. And so my recommendation there is hire an investment banker who's going to, open up maybe 50, 100 different options of potential buyers, and then you can run a process, and that will maximize your exit. What I'm going to cover is how you position yourself for raising money in a way that's going to maximize your exit, right? So in other words, how you raise smart money from sophisticated investor. Remember my previous example. And the way I'm going to cover that is by outlining what I call the 5 Ps a killer business plan. If you guys are familiar with the 4 P's of product, that's basically what it is, with one more. The fifth one is people. I'll cover it last, but it really should be the first one. Okay, so the first P, your product, when you pitch your company to an investor, right? Not when you pitch your product to a customer. When you pitch your company to an investor, your product is what I call your business equation. And so if we can just look at this, people may recognize this. It's something that we don't see very much in Silicon Valley. I wish we saw it a lot more. It's a balance sheet, right? Very simple balance sheet. The key defining principle of a balance sheet is it's balanced, right? Asset and liability plus equity are the same. And your revenue, right? The money you get from your customer go in the asset category in the form of cash or account receivables. And then your investor like stakes, the equity that they get in the company, go on the equity side, right? So the bigger your revenue, the bigger the value of your equity, right? For you and for your investors. And so it's pretty simple. Like, you want to maximize your exit, you want to maximize the outcome. You have to maximize that, liability and equity side. And the way you do that is by maximizing the asset side, which is by maximizing revenue. So how you maximize revenue is pretty simple. Again, like, what is revenue? Volume times price, economics one-on-one. So it's number of transactions times revenue per transaction. Depending on the business you're in, even though I know many of you are in a SaaS business, some businesses have like high velocity versus lower velocity. High velocity, think Amazon, one customer buys very often. Low velocity, think, Mercedes, one customer buy one car for the most part. So your business equation is pretty simple, right? Number of customers, how am I going to get more people interested in my service and product? Number of transactions per customer, how am I going to get them to buy more often or come back more often? Revenue per transaction. Looks super simple, but if you're able to outline how you're going to get more customers, you have an acquisition strategy. How you're going to get these customers to come back more often, you have an engagement strategy. How you're going to get higher revenue for each of these transactions, you have a monetization strategy. If you're able to outline that to an investor, I guarantee you they will want to talk to you more. The second P is price. Price for a company is your valuation. So this slide, this image is a photo of my husband's motorbike. He races Ducatis. He loves it. Very special experience for him. And this is a photo of him coming back from a race. He sits down by the fire. At a friend's place. It's really a priceless experience. It's especially priceless because I'm not here. He's really just enjoying that moment, takes this picture. Well, the reality is this experience, just like everything, has a price. Everything has a price, and your company too has a price, even though you may think it's priceless. And this is the price, right? The price of this bike, the price of this experience that my husband has is, the sticker on the bike. That's the list price, plus all the maintenance, all the upgrades, all the service, all the training, everything that comes on top of it that constitutes the total cost of ownership. And this, right? You know this with bikes, you know this with cars, you know this with everything. You should know this with your company too. The list price, which is your valuation, is much lower than your total cost of ownership, which is valuation plus terms. What I'm trying to tell you here is that a lot of entrepreneurs get hung up on their valuation, but really terms are the things that matter. Why that is because most companies, as they go through their life cycle, they will hit that bump on the road. And when they hit that bump on the road, and maybe there's a that's at a time where you need money. You may raise a round that's maybe a little bit of a down round. The first person to get hurt is not your investor, it's you, the founder. And when you think about maximizing your exit, you may sell at a price that's not exactly what you wanted to sell for, but your investors will still get their money before you get yours. And so you want to make sure that when you think about raising money, when you think about valuation and terms, you always operate on fairness and you always watch the terms, because otherwise you may be one of these few founders, I know a few, and they're not happy people, who sold a company for a very large amount of money and they got very little for themselves because along the way they raised money at too high of a valuation, and so when the exit comes, they get crammed down. So always operate with fairness here. The next thing is when you're looking to raise money, again, with the perspective that you want to maximize your exit, you want to really get as much smart money as you can, because the more smart money you have on your cap table, the more your investors will have the right connections to help you maximize your exit. And so my recommendation is, think of fundraising as some form of sales and marketing. Do reference, right? Do referrals. Don't do digital marketing like an angel list. Do that maybe if you're super early, but if you're like a little farther along the way, leverage your smart money to get more smart money as opposed to doing digital marketing. Don't do cold calling, right? Don't just like try to reach investors cold. We get about 4,000 deals a year, and I can think of maybe 2 of these emails each year, 1 or 2 of these emails that I get that are so personalized and so compelling that I'm like, wow, I'm really impressed by this cold email. But almost everything else, for us to pay attention to it comes from a referral. And then finally, unless you're at a really late stage, and I'm talking mostly for Silicon Valley money, don't use an investment bank for fundraising. Use them for exit. They're invaluable at the exit stage, but less so when you fundraise. And then that email, that content you see here, that's the typical email I send when I'm trying to convince an investor to co-invest with me. And basically, in essence, it says, hey, X, I've invested in this company. They're doing amazing. I'm putting more money in. I think it's a great deal and you should come in as well. That's the kind of introduction you want. In fact, the kind of introductions you want are to get smart money are from an investor who has invested in you and is recommending your company to another investor, so they can have an investor to investor recommendation, or from an industry expert, right? One of your advisors who's an industry expert who does not invest, but is recommending you to an investor saying, oh, I think they have something based on my expertise, or from another entrepreneur who is in the portfolio of that investor. Hey, you have invested in me. I think you should also consider that company. And that's it. In other words, 1, 2, 3, right? Or 1, 2, 3, depending on where you're calling from. You don't want, and please don't ask, an investor who's not investing in you to make investor intros, because this is how it's going to go. Hey, Bob, I'm not going to invest in this company, but I really think you should. And how do you think that's going to help you? It's not. And so remember that when you get introductions, an investor who's invested, an advisor who does not invest but recommends you based on what's special about you, and then an entrepreneur in the portfolio of an investor. The next one is, we talked about it, is you want smart money. Smart money, be prepared for it. Their job is to say no to you. That's one of the massive differences between the job of an entrepreneur saying yes and the job of an investor saying no. If you come to an investor, you say, hey, like I'm just making that up. With COVID, our revenue really took a hit, and we've had to lay off some of our key people. And now, we have a really short runway. I mean, if we could only get $2 or $3 million, we would really be able to get out of this challenging situation. Like, you've just given me like 3 different reasons to say no, and my job is to say no. So I'm going to say no because that's my job. But if you come and you say, wow, with COVID, or, with this year, we've put a lot of effort into building an amazing sales and marketing organization, and now our revenue is doing great. And, I have so many customers that I've signed already. I'm really trying to staff my customer success team. And, in order to hire all these people, I need some money. Like, you're basically telling me, hey, the train has already left the station. You can be on it if you act fast enough, right? Then as an investor, I'm going to be very excited about this opportunity. And then finally, the 5th P is the people P, which is your co-founder or your founding team or your management team. And what I recommend here is that you look at it against 3 criteria. These 3 criteria, where do they come from? In my prior life, prior to being an investor, when I was a serial entrepreneur, one of the things I did was I run a network. I founded and run a network called Founder Dating, which is a professional matchmaking for founders. And so I would try to help founders find co-founders. And so I interviewed thousands of co-founders and learned to really help them identify what makes sense for them in terms of finding a compatible co-founder. And it comes down to these 3 criteria: complementary skill set. You want a team with a diversity of skills. Not everybody is an engineer. Not everybody is a salesperson. Compatible communication style. There's going to be bumps on the road, many of them. You want to make sure that you're able to come out of them with a solution that allows you to move forward. And then finally, comparable risk profile. That's especially important in the context of an exit. Let's just pretend, have a scenario where we say we have one co-founder, it's their first venture, and they could only dream of a $10 million exit, right? That's all they want. And they're going to use the proceeds to buy themselves like 3 Ducatis and race around the world. And that's just perfect. And then the other co-founder, it's like an IPO or nothing, right? They've had a couple of ventures and they say, well, I've sold companies. Now it's like, I either go IPO or I'm not interested. Then comes an exit by a potential acquirer for 50 million. Now the first co-founder is like ecstatic, 5 times more than my wildest dream. And the second co-founder is like offended, like, excuse me, I am worth like $1 billion exit, not a $50 million exit. That is basically going to ruin the opportunity for both of them, right? So comparable risk profile, when you're thinking about putting together your exit playbook, is absolutely critical.
That was really, really good. I learned a ton, super valuable. And like I started the conversation with, many founders don't think about baking that in as they start their company. And it just becomes more painful as you grow. And a lot of people probably realize this as you went through the presentation. So the first question is, how do you know whether to choose convertible debt versus equity in an early round? Is the size of the round or the stage of the company that is most important for this?
Yeah, so if there's a couple of things, first of all, you're going to take the money the way your investor gives it to you. So very often you don't have a choice. If you do have a choice, then think about like, what is a convertible note, right? A convertible note is generally called a bridge round. And so you want to think about like, is this a bridge to my next round, as opposed to a bridge to nowhere, right? And so you can raise an equity round in a, you can raise a convertible note if, for example, you're thinking like, hey, we're doing really well, but we need like 3 to 6 months of additional, leeway in order to get all the customer feedback we want to see to get a better deal on our Series A or on our seed round. Well, that's a great reason to raise a small note. Make it small, make it very targeted, make it like, I just want to get over that bridge, right? So that I can hit that milestone, so that I can raise a round on favorable terms. Again, like think about the terms, because that's going to maximize your exit. And that gating factor, right? That other side of the bridge, you want to make sure that you have validated with your potential investors that yes, if you meet these key milestones, give or take, right? They're never going to give you like a super black and white answer. Then it will be a good time to raise a round on favorable terms. So that's how I would think about, convertible note versus equity. As far as everything else, right? Like, and when I say everything else, I include like safe notes, kiss notes, token sales, everything else. I don't recommend, crowdfunding, all of that stuff. I don't recommend it. And I don't recommend it because you want smart money. Smart money is sophisticated, is picky. They have a certain way they do things. You don't need the complication, because it's only going to basically lower the bar, make it really hard for you to get that smart money. So don't go and play with what, general investor will call the financing risk. Just go with a plain vanilla term sheet or note.
On bringing additional investors into the round, is it good to take it all from one investor? Should you expand it to 5, 10? Like, what is the max? What is the min? Because there's also added complexity as you add more investors, especially depending on the size of the round.
Yeah, so it's pretty simple, right? You don't ever want to have like one of something except for your wife or your husband. And here's why, right? If you have just one investor, you basically start working for them. And so one of the key drivers we find for entrepreneurs is they want to, have flexibility on how they run things. And so you want to have multiple investors. By the way, it's not only just for you, it's also because it keeps your investors in check. Sometimes your investors have their own agenda, right? So you may have an investor who gets on your cap table and whatever, they want a very quick exit. And so they're going to push you to exit really, really quickly. But maybe it's not the right thing for you, or they want a very, very slow exit and they want to deploy a ton of capital into your company in order to maximize their returns. Well, that's their interest. That's not yours, right? So by having multiple investors, you sort of neutralize the interests and the self-interest for the benefit of the interest of the company.
What are your thoughts on building a durable competitive advantage? Like, how do you suggest founders do this from the beginning? How much is it worth, et cetera? And tying into this question is, you talked about different stages of exits and the kinds of acquisitions. Not everybody is going to be a slow flake. Of course, everyone has the dream to be that. But what are the different kinds of value you build into your company so you become attractive?
Yeah, so when we do due diligence on a company, we look at 4 criteria. We look at the team. That's the number 1 criteria. We want a stellar, outstanding team. So if you're going to spend time, like always spend time on hiring, grooming, coaching, mentoring, training I think I was just rereading the hard things about the hard thing about hard things, and Howard says that too. Like, spend a lot of time training and developing your people. After that, what you want to be looking at is your product, in the sense of like, how defensible is it? And when I say defensible, we hear a lot of entrepreneurs come and say like, oh, you know, it's defensible because we have that feature and our competitors don't. Well, that's not defensibility. You want to think about defensibility in the eyes of your customers, both in terms of offense and defense. So offense will be, well, you know, once we sell to a customer, they give us all their data. And so for them to transfer over to someone else, it's really difficult because they have to convert their data, We have a competitive advantage this way. Defense, well, we filed a number of IP patents on our technology, and therefore, you know, we're protected against defense. What you want to think through when you think about defensibility is, when I get real traction, and my small competitors, who by then will be faster than me, and my big competitors, who still then will have bigger distribution, bigger muscle, bigger execution capabilities, they see what I'm doing and they say, oh, that's what needs to be done. Let's just copy that right now, right? So they're not going to go through the zigzag you went through. They're just going to go straight for the jugular. We're going to do exactly what these guys want. How do you continue to win? That's the key question you want to ask yourself. Now, that's really on your, the product defensibility, but your best defensibility is customer traction. Once you start to get references, you get more customers because you have happy customers. And so remember, like, the team, then the defensibility of the product offering, then your market defensibility, which translates into your financials. Definitely. That's how you maximize your exit.
And then how does this change, right? Let's say you're not an early founder. You've had a couple rounds of funding. Maybe let's say you've raised 15, 20 million or so. At what point, how does that thinking shift, in your opinion?
Yeah, so that's where it becomes really important to think through the entire life cycle of your company. I mentioned to you that 97% of exits are under $100 million. And so think about the math, right? Let's say you raise from smart money, right? You do the right thing. Smart money is going to want a good multiple on their investment. They're going to want at least 3x, right? Or maybe 4 or 5x. So let's just, to keep the math really simple, say they want 5x. It means that for $100 million exit, your company should not take more than $20 million of capital so that you can give them that 5x. And so it means that you need to build your company to generate enough revenue to be sustainable with $20 million of investment, right? That's when the unit economics start to really make sense, where you say, for every dollar that I've raised, I've generated X dollars in revenue. And that's how you want to be thinking about it.
Definitely. Any advice on not letting due diligence distract you or your team too much? And when do you tell the rest of the company?
You mean when it's comes time for an exit?
Yes, exit, or like a majority buyout, or whatever you want to call it, right? Big round of funding,
yeah.
things that have impacts.
Yeah, so this is a really good question. So you remember I mentioned 2 scenarios, the opportunistic scenario. Hey, I just got an opportunity thrown at me and I'm not really looking to sell, so I'm going to just explore it casually. Versus the, well, I got an inquiry and I'm realizing that it's time for me to get out of this business or to sell the business, and I'm going to fully explore. So if it's purely opportunistic, keep it to you and, you know, maybe one of your board members, really small, nobody else. If it's a process, then keep it small, but you'll have to include your CFO. As you go further along, you'll have to include your general counsel, and then maybe one or two key people in your management team. And then that's it, like nobody else. The minute you say we're up for sale, everybody's going to start counting their chickens. Yeah. And completely distracted from the business. So by the time the word gets out, you really don't have a choice anymore. You have to exit, which gets you to lose a lot of bargaining power. And then, the other thing is, if you have a board and you get one of these inquiries, it's your responsibility to always bring the opportunity to the board.
Definitely. Let's shift to valuations a little bit. What are some of, or rather the metrics behind those? What are some of the metrics that you look for, especially at Moatti, and then the companies you invest in as they go to raise future rounds? What are the metrics required at an A level and then at a B level? I'll stop at the B sort of.
Yeah. So in terms of valuation multiples, we look at valuation to the revenue. If you value to the ARR, you can have them, give or take. We see right now in Silicon Valley, right, for Silicon Valley companies, we see maybe an 8 to 10x multiple to the revenue, which is in line with public market valuations. Yes, there are crazy exceptions, Snowflakes, Zoom, and a bunch of others. But generally for SaaS, that's a safe and accepted multiple to the revenue. And then in terms of key metrics that we look at, I don't think it'll come as a surprise to you guys. It's really the LTV over CAC key metric for us, and then a couple of others, but these are the really key ones.
And then when you look at the time horizon of different founders, right, as you're looking at exits or future rounds, have you come across situations where one founder wants to leave the company, they have the vested equity, they want to probably sell their shares? How do you manage that as an investor when you advise founders?
Yeah, so generally speaking, you'll want, like, depends on, if is the founder maybe like the technical co-founder who was super valuable early in the venture, and then they're like, yeah, now the company is a company, I'm not really as excited, so I want to stay as an advisor and go start something else. That's something that is possible. If that founder is really able to transition to a VP of engineering, but generally speaking, it's not desirable. So we'll the other more common scenario we see is, hey, I want to have a little bit of an exit so I can buy a house, and that's a frequent scenario. And generally, that's something we like to support. It's good for our founders to do that. There's a third scenario where the founder needs to go because they've become maybe detrimental to the business. It happens more than you'd think. In which case, there's a sort of a whole other process to deal with that.
Awesome. What role does the board play when negotiating either an exit or future rounds?
Yeah, so huge role to the board, right? The board, especially in a private company, represents the major shareholders, which are you and your investors. So they are the ones who really review, approve anything that has to do with people and money. So they most of the time will delegate the fundraising to you, but they ultimately will approve, term sheets, they'll approve M&A and so on and so forth. And it's really important to keep them involved because they are also liable to the investors for, any missed opportunity.
Really?
So if you're thinking about so here's another maybe something helpful for first-time founders. Most of the time I see first-time founders are like, I don't want a board. They're going to be hovering over my shoulders. I really encourage you to think about it differently and think about your board as like your biggest supporters. They want nothing more than for you to have your very successful business, super big exit. And yes, it's their job to be, putting pressure on you to deliver on that, but it's also what's going to help you be successful. And they have generally huge connections, experience. If you choose them wisely, that will help you.
Definitely. How do we think about dilutions at different rounds, right? So like friends, family, fools kind of round, pre-seed, seed, Series A. What do you advise founders that they should dilute at every round? And like post A, where should, let's say a company with 2 founders or 3 founders, post A, how much should a founder end up with?
Yeah. That's a great question, and let me share with you maybe the scenario that I think you're trying to avoid with that question, which in essence comes down to seek fair terms, raise as little as you can. You start a company and you raise an angel round, like friends and family round, and you give them, let's just keep the math. I'm going to keep the math broadly simple, right? You give them about 10% for their money. And then you move along your journey and you need a little bit of money to develop your product from having this prototype because it shows some promising interest. So you're going to go raise maybe a pre-seed round that's going to dilute you by another 10%. And that will get you to have maybe a couple of pilot customers. And so by then you're ready to raise your seed round, which let's assume seed round is just 10%. It's generally a little bit more. And maybe before that or around that time, you go to an accelerator. You say, well, I've raised a little bit of money. I have a product. I have a few customers. Now I'm gonna, go to an accelerator. Maybe you do accelerator before you do seed. Sometimes you do that. Sometimes you do the other, and they're gonna take another whatever 5, let's just say 10% to 40%, and then you say, well, okay, so now I have my seed round. My next step is A round, but we know there's a Series A crunch, and so I need to raise a little bit of money, right? A pre-A round or a post-seed round. Say another 10% in order to get to a Series A on favorable terms, right? That's 50% that you've lost already. And generally the Series A is going to come in at 20%. And they're also going to create an option pool that's going to be let's just say 10%. So by then you have maybe 10 or 20% ownership for you, the founding team. And that's generally where your journey ends, because no investor will put money in a Series B when you have so little ownership. And so what ends up happening in scenarios like this is either the business gets stuck because it cannot raise money, or your investors, your Series B investor will recap, right? Do a recapitalization, which means they're going to say hey, that 100%, 20% to you and all the other investor, we're just going to say it's actually only 50%. And we're going to give, you, the founder, a little bit more, us a little bit more. We're going to increase the option pool, whatever. And so they're going to cram all the other investors, which you can imagine the dynamics there. It's going to be painful for you to manage. Or they're going to cram you even further down, at which point, to Lloyd's point, you may have some founders who say, well, that's not worth it for me anymore, so I'm leaving. So you have another problem. So you basically end up with a situation where you have to do a cram down, and nobody ever wants to be in these situations because there's no happy outcome from there. So the lesson is, you know, the smallest amount of money you can raise along the way, so you get the least amount possible of dilution, the better off you will be, and the farther along you can go.
Switching back to the whole valuation, equity, and all of that, when a company is bootstrapped or delays taking funding, right, or takes as less as possible, they don't necessarily then have all the resources, and they consider bringing on advisors. What do you recommend founders give in equity to advisors, or do they even give anything at all?
To advisors,
Especially someone who's super connected, can help them through an exit and whatnot.
So this is typically what how you have to think about it, or how you want to think about it. If that person is an investor, don't make them an advisor, because this is what will happen. Like, let's say, yeah, I'm an investor, and you tell me, like, why don't you become an advisor in my business? Then I talk to somebody who's an investor of yours, like a reference call. I say, oh, no, I'm only an advisor in this company. I'm not an investor. Oh, is it not good enough for you to invest? Like, what's going on, right? So you never want to invite this type of conversation. So lesson number one, if you want to attract an investor, get them to invest, not advise. Now, if you want to attract somebody who's not an investor, they don't invest, they're just an expert at X, Y, and Z, then you want to do a combination of cash and equity. Why? You want to give them cash because you want to care. Like, cash is one of your most valuable resources. So if you give them some cash, you'll be like, hey, I want value for what I'm giving you. And then equity is because you want them to care. Like, hey, I have equity in this company. I want it to be very successful. So they're going to help you maximize the value of that equity.
Do you invest in pre-revenue companies?
We don't. We do Series A and Series B. But if you're pre-revenue, this is my recommendation so that we get to know you. Become a member of Products That Count, that product network. So go to productsthatcount.com, become a member, start getting our newsletter, attend some of our free webinars and stuff. And then in due time, like, you're going to grow, you're going to find value from it. We put you in touch with 300,000 product managers. And then in due time, as you grow, in parts thanks to that network, you and I can get back in touch for your post-seed or your A round.
Fantastic. And I guess it goes without saying, since this talk is about exit strategy, when people come to you to raise money, most of their decks do have an exit strategy baked in there.
Yes, that's one of the questions we always ask. And frankly, it's not so much like, we don't want like, oh, I want to exit at 20 million for, that's not what we look for. We really want you to understand that that's your success, that's our success. And so we want you to be exit minded.
Fantastic. And my final question is, since you're a product leader and entrepreneur turned VC, what are your favorite products right now? Like your top three?
Yes.
That you can't live without.
That's great. So a couple of ways I can answer that. One is, I've consolidated my phone apps on one single screen. So I don't want to have to deal with like a ton of apps. And so, I use Slack all the time. I use Airtable a lot, and I use Amazon. And so that's one. Slack, Zoom, Snowflake, Datadog, DigitalOcean, Amplitude, like that sort of new crop of companies. We love them because they are proving a point that's really dear to my heart, which is that the best product wins. It wasn't always the case. I started my career working for Siebel Systems, so I know that for a fact. But now in the era we live in, where the expectations are that the best products are going to be like like our phone, are going to be apps that are super easy to use. We see all these products win massive market shares, like Zoom being a perfect example, right? Zoom has 50% of the market and competes against like freemium with massive distribution like Google, Microsoft, right? And it's still able to get 50% market share. And why? Well, because it's the best product. So we're very excited about that era we live in.
Awesome. And if you want to learn about building great products, I think SE dropped the link, but Products That Count is a fantastic community. And if you want to learn everything else about growing a startup, tractionconf.io. Thank you so much, SE, for joining us. I learned a ton. I asked a lot of questions that are burning for me as well. Today's session is brought to you by Boast AI, Launch Academy, in partnership with Lazaridis Institute, Founder Institute, and BCF Ventures. Thanks everyone for joining.
I need some traction.